we want to incentivize alternative energies like solar, like wind, like hydrogen, like even nuclear. And those are now have tax incentives for them. And she rents a house for like 10 days for $80,000 a day in Paradise Valley, Arizona, up the street from her. They pick it up in their zero tax bracket, and you just saved basically 40 cents for every dollar you paid your kids. Donald Trump on his tax return has a lot of interest income, about $10 million of interest income. Well, what happened is that as one of the pay-fors, one of the revenue raisers in 2017, they said, well, look, we're going to only...
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today, we have a very special guest. His name is Tom Wheelwright. He is the author of Tax-Free Wealth, and today he is going to be giving us an overview of his book. We're going to be talking about everything that has to do about investing in energy. We're going to talk about real estate. We're going to talk about 401ks, business, just different ways that you can save money as a business owner, as an investor, being self-employed, or even an employee as well too. Welcome to the show, Tom. How are you?
I'm great. Thanks for having me.
I love it. Thank you so much for coming on. So for our viewers that don't know who you are, who is Tom Wheelwright? And then how did you get involved in this world of tax planning?
Well, I've been in this world for over 40 years. So I actually I got involved in it because I had a terrific professor at the University of Utah, my undergraduate, that was a tax professor. I actually took my tax classes before I took my accounting classes because I thought, well, tax is a really good combination of numbers and law. And so it was very, boy, this sounds great. Had a great professor. I learned a lot. And then I got my master's of tax from the University of Texas, spent 7 years with Ernst & Young, including 3 years in their national tax office, where all we did was tax planning and teaching. And then I spent 4 years in-house with a Fortune 1000 company, in-house tax advisor. And I spent about 25 years buying, building, and selling CPA firms. And the last 5 years have been building a network of CPA firms and recently launched the Wealthability franchise. So in the meantime, I taught multi-state income, sales, and property tax at Arizona State University in their Master of Tax program for about 14 years. And I've traveled all over the world with a fellow by the name of Robert Kiyosaki, Rich Dad, Poor Dad fame. So Robert's been a great mentor and a friend of mine.
I love it. I was going to say that most people probably know you with that relationship of Robert Kiyosaki. Basically, you guys have done a lot of great things together. I wanted to ask you, this is a question that I had. Like, I heard this, I don't know if it was a conspiracy theory, but I watched this video like 10 years ago and it said like, oh, legally, according to the Constitution, you're not required to pay taxes. And I didn't know, like, it always kind of stayed in the back of my mind. But he's like, if you never file, then they can't come after you for not paying taxes. And I just want to know, is that true or is that a rumor?
No, that's false. Let me tell you where those people go make their mistake. Mm-hmm. There's some evidence that the 16th Amendment to the Constitution, which allows for a federal income tax, was perhaps not ratified properly, and that's what they're relying on. However, people think the Constitution is the highest law in the land, and it isn't. The Supreme Court is the highest law in the land, and the Supreme Court said that the 16th Amendment was ratified properly, and so everybody has to pay income tax. We're all subject, we're all partners with the government, whether we like it or not. There's no secret way to say, I'm exempt. Hey, guess what? You can't come get me. You don't file. Here's what happens, in fact, to go to your point. If you don't file, your statute of limitations never starts, which means the IRS can, let's say at 18, you get your first job and you say, I'm just not going to file taxes. And let's say somehow the IRS doesn't catch up with you for 20 years. They can go back 20 years and assess taxes for 20 years. What's worse is you can only claim a refund for 2 years. So they can assess taxes as long as they want, but you got 2 years to claim a refund. That's it. Wow. So, those when you hear that kind of stuff and you're going in the back of your mind, God, this just doesn't quite sound right. Well, there's a reason it doesn't sound right because it's not right. It's not the way it works.
I remember when I watched that video, I was like, could this be true? Could it not? I was like, okay, let me ask Tom. The other thing I wanted to ask you, so like during the, I think 2016 election, there was a lot of controversy about Donald Trump. And there was a lot of controversy about him showing his taxes as well, too. And a lot of, I remember this video that said if he paid taxes or not. And he said, look, I use the same tax exemptions that a lot of your donors use. So I wanted to ask you, like, what does Donald Trump use to reduce his tax bill? Obviously, like, you probably don't know the exact things, but are there, if you had to take a guess?
I do actually, because the guy who released his tax returns to the New York Times was just sentenced to 5 years in prison. Okay, he was a contractor at the IRS. He went in there with the sole purpose of stealing tax returns, and he stole 3,001 tax returns. He stole Jeff Bezos, Elon Musk, all these other tax returns, and he stole Donald Trump's tax return. He released them. He released the 3,000 to ProPublica, and then he released the Donald Trump's to the New York Times. He recently literally got a 5-year sentence for doing that. But they were released, and the Democrats decided we're going to release them to the public. And so I have been through them. So I do know exactly what's in there.
So
and
just out of curiosity, is there anything illegal in there, or is it
nothing at all? Here's the thing. What people don't understand is how the tax law actually works. So the tax law, people always think, well, the tax law has all these loopholes for the rich. No, the tax law is basically says all income's taxable unless we say it isn't. Nothing's deductible unless we say it is. And then 6,000 pages is basically a roadmap to reducing your taxes. It's just an instruction guide to how to pay less taxes. And you go, well, why would they give us an instruction guide for paying less taxes? Well, because the reality is, so think about it this way. When you got your first paycheck, you probably looked at that pay stub and you go, who the heck's this FICA guy? Why is he taking all my money? Right? That was Rachel on Friends, right? And what you realize pretty quick is, hey, I've got a partner. I don't want him. I don't want this person. I don't want Uncle Sam for a partner, but Uncle Sam's a partner. And I don't get to choose whether he's my partner or not. What I do get to choose is what kind of partner am I going to be? Okay. Am I going to be a silent partner like 90% of the public? Or am I going to be an active partner, meaning I'm doing things that the government actually wants me to do, and they incentivize certain things? For example, you own a business? Guess what? I mean, think about this. A couple of simple things that I'll just prove that it's just a series of incentives, the tax law. First of all, if you buy a house, you get a deduction for your mortgage payment. If you rent a home, you don't get a deduction for your rental payment. So that's just an incentive to buy a house. That's all that is. Okay. Why do renters not get the same deduction that homeowners get? Well, because Congress decided many, many years ago that home ownership created stable workers. And so they wanted to encourage home ownership. And the way to do that, let's allow you to deduct your interest in your taxes. Okay. Here's another one. You start a business. So go back to COVID, right? During COVID, everybody worked from home. Now, these days, a lot of people still work from home, but not everybody works from home. But everybody worked from home during COVID. If you were an employee working from home, you got no tax benefit. But if you were self-employed working from home, you got to deduct your internet, you got to deduct your utilities, you got to deduct your office, you got to deduct a part of your house, you got to deduct your cleaning and maintenance, you got to deduct all these things because you're a business owner instead of an employee. So what's that? That's just an incentive to own a business. I actually, in my second book, The Win-Win Wealth Strategy, I actually wrote about, gave an example where you could literally start a small business from your home, just a side gig, right? Something off your computer. And the tax benefits are greater than the cost of starting the business. So literally the government will pay you to start a business. And I just proved it. I just went through the numbers. Here you go. And I proved that the government literally will pay you to start a business. Well, what else does the government want to have happen? And when you start thinking differently about the tax law, what you start realizing is, well, wait a minute. So what does the government want to have happen in my country? Because it's not just the US, right? I mean, I've studied 15 different countries, and the tax law is pretty similar in all 15 countries. The tax incentives are the same. So here's number one. Number one is business, right? Every government wants to incentivize business. Why? Because it drives commerce, it drives innovation, it drives jobs. Okay. Then what else do they want to drive? Well, they want to drive innovation. So that's why we have research and development expenses, tax credits, et cetera. Actually, the U.S. has fewer of those than most countries. They want to drive housing. They want to drive food production. I've had a number of clients who were in farming or ranching. I've never seen them pay tax because the deductions are so great that they rarely pay income tax. Farmers and ranchers rarely pay income tax. Why? Because the government recognizes that food production is the most important thing we got from a security standpoint in the entire country, right? We need to produce enough food for our people. We need to export food. We need safe food. We need all these different things. So there's huge incentives for food production. Well, what else do they want? Well, they want energy. So back in the 70s, they started incentivizing oil production, right? Oil, fossil fuel production. And those incentives have never gone away. They're still there, okay? But recently, they've gone, well, wait a minute, we want to incentivize alternative energies like solar, like wind, like hydrogen, like even nuclear. And those are now have tax incentives for. I'll give you an example. I put solar with batteries on my office building, and the government paid 2/3 of the cost. 2/3 of the cost. I mean, my return on investment, I mean, I live in Phoenix, Arizona, so it's sunny all the time, except right now when it's raining. But 300 days a year plus, it's going to be sunny, right? So solar is a low-risk investment in Phoenix, Arizona. Really low risk. But the government will pay 50 to 65% of the cost through tax benefits. Especially if you do it on a business building or a rental property. If you do it on your own home, they'll pay about 30%. But if you do it as a business, they'll pay twice that. Okay? Because again, businesses get the incentives. The reason I wrote tax-free wealth is, as a tax advisor, I wrote Tax-Free Wealth 2012, first edition. Now we're on third edition. And the first edition I wrote in 2012. Well, I'd already been in practice for 30 years at that point. And I'm going, look, this should not be a secret. How the tax law works should not be a secret. This should be available to every single person. Everybody should know this. And frankly, with tax-free wealth, if you don't know it, it's just because you weren't willing to read tax-free wealth. Because basically what we do is we just lay it all out there in very simple terms. This is how it works, from things that you may have heard of, like the Augusta rule, where you get to rent your home for 14 days and not pay tax on the income. Rihanna, by the way, last year's Super Bowl. So it's in Phoenix, Arizona, right? And Rihanna's singing at halftime. And she rents a house for like 10 days for $80,000 a day in Paradise Valley, Arizona, up the street from me. Mm-hmm. The person who rented that home out to her paid zero tax on that $800,000.
Why?
Because it's in the law. It's in law. It actually came about. Because of the Masters Golf Tournament in Augusta, Georgia. It's literally called the Augusta Rule. And if you just rent your house for 14 days or less during the year, you don't have to pay tax on the income. It's a specific rule in the tax law. Okay. Another thing that people don't know is like tax brackets. So people go, well, I'm in this really high tax bracket. There's nothing I do about it. Well, that's not true. Do you have kids? Well, yeah, I've got kids. Yeah. What tax bracket are they in? Well, they're in a really low tax bracket, but they're probably in a zero tax bracket. Well, why don't you have your kids working in your business? Now you pay your kids, you get a deduction in your business at your high tax bracket. They pick it up in their zero tax bracket, and you just saved basically 40 cents for every dollar you paid your kids that they can use for family vacation. They can use for college. They can invest. You can teach them how to invest. I mean, these are, to me, really simple things. But they're things that everybody should know how to do.
I agree with you. No, I agree with you. And I think that's one of the things that, like, once I learned that the taxes are actually incentives and taxes are a way to stimulate the economy, and also that there's a book that you can actually read. And if you read it, it'll tell you what the government wants you to do, where they want you to invest, where they're looking to grow. And if you just invest in those things, you get deductions. Let's start off here, because I think that this is a good principle. And I don't think, like, before reading the book, I wasn't 100% familiar with the cash flow quadrant. And I think that if people understand the cash flow quadrant, it'll allow them to kind of think like, okay, why do employees and self-employed people get the least deductions? And why do business owners and investors get the most deductions? And then how can somebody potentially move from the E and S to the B and I section? So if you wouldn't mind just going over the cash flow quadrant, what it is, and then what maybe somebody can do if they're an employee or self-employed, what they can do to move to an area where maybe there's more incentives for them.
Yeah, of course, because, and this is good because, first of all, the tax law is fair. Two people doing the exact same thing, the exact same way, get the exact same result. Okay. From a tax standpoint. So the tax law is exactly fair. Okay. If you think I'm an employee and you're a business owner, therefore, and the tax law favors you because you're a business owner, therefore the tax law is not fair. No, you can be a business owner. You chose not to be a business owner and you chose to be an employee. So you chose your tax situation. Okay. This is the point. Tax-free wealth. I wrote tax-free wealth so people get a choice. Okay. If you don't have the information, you have no choice, right? You're just stuck with what you've already been taught. You already do. If I always do what I've always done, I'm always going to get what I've always got, right? So let's look at cash flow quadrant. So this is Robert Kiyosaki's second book after Rich Dad Poor Dad, and actually a really good how-to book, right? Rich Dad Poor Dad is real conceptual. Cash flow quadrant's really okay. Here's the guts of it. So think of it this way. There's 4 ways that you can make any kind of serious money. You can do it as an employee. I mean, look at these high-paid CEOs, football coaches. You know, these are all high-paid employees. So you can make a lot of money as an employee, right? You can make a lot of money self-employed or a superstar or a specialist, a doctor, a lawyer, a singer. Taylor Swift makes more money. I mean, we know she makes more money than God, right? So, and she's self-employed. That's what she is. She's self-employed. Okay. You can make money as a big business owner, Warren Buffett. Okay. As an example, you can make money as a professional investor. Donald Trump, who may lose all his money this year, but he would be an example of that. But, other investors would be good examples of that, right? Professional investors, real estate investors, agriculture, et cetera. But here's what's interesting. So the very first question that your tax advisor ought to be asking you is, how do you make your money? Because the first thing I need to know if I'm talking to you as a new client is, okay, how do you make your money? Well, I make my money as an employee. Okay. All right. So you're probably going to pay 40 to 50% in income tax. And there's not a whole lot you can do. You can max out your 401k. But if you're just going to, if that's how you make your money and that's how you're going to make your money, you're done. Okay. You save money, you spend money, you pay tax on that money. That's the rule. Okay. Now I'm a small business owner. Okay. So I'm a small business owner. My 4 companies, we have a total of about 40 employees. Okay. So I'm a small business. And, so a lot of small businesses, they'll pay up to 60% in tax because they're paying both the employer and the employee side of the tax. Well, but small businesses and big businesses, so there are limits on who can be taxed as a small business. There are no limits on who can be taxed as a big business. So in other words, I can choose my small business to be taxed like a big business. Well, what's the difference? Small business, typically I'm on Schedule C. I'm doing it because it's easy. I don't have to do a balance sheet. I don't have to, my accounting can be sloppy. It's okay. All right. So I'm a Schedule C. I pay 60% tax. All of a sudden I choose, no, I'm going to be taxed like a big company. I'm going to be taxed like Amazon. I'm going to be taxed like Tesla. Okay. Now all of a sudden my tax rate's 20%. I went from 60 to 20% simply by changing the way I earn my money. I'm going to earn my money like a business owner, not like a sole proprietor. And then if I make my money as a professional investor, back to your point on Donald Trump, you look at his return, and I did. I looked at all the years that were available, and I think 1 year he paid $750 in tax. Okay, and that was it. Why? Because he's a real estate investor. That he makes all his money in real estate, has a lot of debt, which maximizes the amount of real estate he has. The tax law is extraordinarily favorable to real estate when you're talking about commercial property and multifamily. And so he paid no tax. Now, here's a secret nobody knows, okay, except a few of us that looked at his tax return. So last year tax return that Donald Trump we had was 2020. And because of a law he changed while he was president in 2017, in 2021, I guarantee you he paid $4 or $5 million in tax because of a law he changed. So he actually changed the law to pay more tax. He ended up paying more tax as a result of his law. So he didn't change the laws to reduce his taxes. The changes that were made in 2017 increased Donald Trump's taxes.
Were those changes in reference to like bonus depreciation and cost segregation? Or what were those changes?
Now those were positive, right? Those actually increased the deductions. No, what happened is Donald Trump on his tax return has a lot of interest income, about $10 million of interest income. Well, what happened is that as one of the pay-fors, one of the revenue raisers in 2017, they said, well, look, we're going to only allow you to offset business income with business losses. Well, real estate losses, bonus depreciation, those are business losses. They can only offset business income. But Donald Trump had $10 million of interest income. Can't offset that with business losses. Therefore, he's paying tax on that interest income, even though he might have $15 million or $20 million of business losses. So he actually basically shot himself in the foot with that law.
Do you think he knew the implications of that when he did that? Or do you think that was something that...
I have no idea. I mean, I don't believe politicians ever really know what they're doing and know the implications. I mean, there are a few exceptions. I think Paul Ryan, he pretty much knew what was going on, right? I mean, that he's probably the most astute politician when it comes to taxes, Paul Ryan. But did Trump know? Maybe, but my guess is maybe not. Maybe not. So...
I wanted to ask you, so like the majority of the money raised in taxes, does that come from like the super extra wealthy, or does that come from like the middle class or the poor?
Middle class.
Like, what is that middle class?
All the incomes in the middle class, all the taxes are paid by the middle class. This whole idea that the wealthy, we need to tax. We just go after the wealthy because they're cheating on their taxes. I've met a few wealthy people who cheat on their taxes, but the reality is wealthy people don't need to cheat because they have high-priced accountants like me. And I can show you how to, I have a number of clients that don't pay any tax legally. They file tax returns, but they do everything right. They do what the government wants them to do. They don't pay tax. And now, you really have to pay attention to do that. I literally can't reduce your taxes, but I can tell you what you need to do to reduce your taxes. And then you have to choose, do you want to do that? So like Donald Trump, when he said, he was telling Hillary Clinton, I've seen that video. He's telling Hillary Clinton in that debate, he goes, well, look, I'm using the same, if you don't like the way the tax laws are, you don't like that I don't pay taxes, go change the tax law. But the reality is your donors are using the same provisions I'm using, and they're not going to let you change the tax laws. Okay, that's the way it works. Now, do the rich make the laws? Absolutely. There's no question about that. They lobby for it. They get the laws in there. And so, it's not my job to say, is this good or bad? My job is to just explain what it is. And then you get a choice, right? But the reality is you get to choose. If I want to, so I'm a business owner. I have hundreds and hundreds of clients. Okay. Pretty low risk. You're an employee, you have one client, pretty high risk from my perspective, right? You have the highest risk in the world. Your client doesn't like you, you got to find a new client. I have a client doesn't like me, so what? Okay, now that doesn't mean I don't care about my clients. I care probably more about my clients than most people do about their employers. But my point is that the rules are different. The rules are different for business owners. The rules are different for investors. So you ask the question, all right, so you're an employee, what do you do? Well, you got some choices. You can become self-employed, so you can basically buy your job, right? You can own your job. That's what a lot of accountants do, right? They go out and they say, I'm going to leave my job as an accountant and I'm going to go buy an accounting firm or start an accounting firm. That's what I did. I left I left a job, Fortune 1000 company, started an accounting firm, and never looked back. It was one of the best decisions I ever made in my life. But it's very natural for me. I love being an entrepreneur. Okay, so you can do that, right? So you can always become self-employed, and that's helpful because business deductions are business deductions. They're the same deductions for a small business, they're for a big business. Now, the other alternative you have is, well, wait a minute, I like being an employee. I don't want to not be an employee. I don't want to own my job. I don't want to, as my partner says, entrepreneurs are the only people in the world who will work twice as many hours for half as much pay. And there's some truth to that. You know that, right? There's some truth to that. At least starting out, there's truth to that. In the end, it shouldn't be that way, but in the beginning, it certainly is. Well, you can always be an investor. So let's take, okay, you got Donald Trump with Trump Tower, and you've got Sally, high school teacher, okay, and she and her husband go out and buy a duplex, and they live in one side of the duplex, they rent out the other side of the duplex. Guess what? They get, the number of zeros are different, but they get exactly the same tax benefits Donald Trump gets. Exactly the same, because the tax law is fair. And the reason we know the tax law has to be fair is we have what's called equal protection clause of the Constitution, which says that everybody has to be treated the same in the same situation, right? That's the equal protection clause. So that means that just because you're big doesn't mean you get better benefits than when you're small. It doesn't. Now, there might be tests you have to meet. There might be things you have to do to qualify. But if you qualify and you have a bunch of single family homes and Donald Trump qualifies because he has a bunch of golf courses, that's okay. Actually, one of the great provisions that you're probably familiar with, you're a real estate guy, so one of the provisions you're familiar with, this is a real estate professional. Do you know who lobbied that into law in 1993? Donald Trump.
Association? Oh, Donald Trump.
Donald Trump. Donald Trump was one of the did some of the lobbying for that law. He wanted the real estate professional. It wasn't in there before then. And he lobbied for that law change so that real estate professionals didn't have the same rules as casual investors. But anybody can be a real estate professional. You don't have to be Donald Trump to be a real estate professional, right? All you have to do is work more than 750 hours in real estate and more in real estate than all your other jobs combined. It's a simple test. That's all you have to do. Okay. And you can have the same, you can be a real estate agent, be a real estate professional, right? It's just not a difficult test to meet, right? You just have to put the time in, but you have to be basically what that I quadrant is. I'm a professional investor. I put the time into it. I'm actually treating it like a real business. I'm really going out there and doing it. I'm not just sitting around, handing my money to somebody else, letting them invest it for me. That's not a real estate professional, but somebody who actually spends the time at it. It doesn't matter if they're spending time at single family homes, multifamily homes, or big commercial properties, golf courses. It's all the same thing.
If somebody was an employee but opened up their own business on the side, like even like got a real estate license or joined a multi-level marketing company, I've heard that would actually benefit them tax-wise if they did.
Oh, for sure, because now they're a business owner, right? So what they did was they moved from the E quadrant to the S quadrant. They may still be in the E quadrant. Okay, so I will tell you right now, I'm in 3 quadrants of the 4 quadrants. Okay, I'm an employee of my own company, right? Here. So I'm an employee. I get a salary, right? Mm-hmm. I'm a small business owner. I have an S corporation. I get pass through entity taxation. Okay, and I'm an investor. Okay, so I invest in energy. I invest in real estate. So I'm in the I quadrant as well, and I aspire to the B quadrant. So 500 employees or more. but really I don't aspire to have 500 employees. I aspire to have other people that I have an ownership in have 500 employees. I don't want them myself. I love my employees, but 40 is enough. I don't need more employees. But can you get bigger and bigger? You can. There are multiple ways to do that. Like Robert, he has publishers all over the world. Well, they're not his employees, but does he have 500 people effectively working for him? Yeah, sure he does.
Yeah.
Okay. But they're in publishing in Germany and in Finland and in Japan and Australia. That's where they are, right? And they're business owners themselves, right? You don't have to employ employees to have the benefits of a big business. You just have to act like a big business.
I love it. You talked about hiring your kids as well too. And when I read the book, that was one of the questions that I had, because it doesn't go into detail. Like, what ages can they be? Do you have to pay them? Can you pay them like as a 1099? Do they have to go through the payroll system? How does that work?
Okay. I'll give you some details there. So first of all, they have to earn a reasonable wage for what they're doing. So in other words, you can't pay them to take out the garbage and pay them $500 a day. Okay. You can't pay them more than you would pay somebody else, basically. You got to pay them a reasonable wage. Next question is, you asked is, do I 1099? In other words, do I treat them as self-employed or do I treat them as employees? Well, I will tell you from a tax standpoint, here's an interesting incentive. So, we always hear that, child labor is bad and, but actually the government encourages it as long as it's your own child, right? As long as it's your own child. It's okay to employ your own child. No child labor laws on your own child, as long as you don't abuse them. And if they're under 18 and your business is either a partnership or sole proprietorship, there's no Social Security tax on their wages. So not only do they pay no income tax, but they pay no Social Security taxes. Now, if you pay them out of your S corporation, we talk about your S corporation, you pay them out of your S corporation, you're going to pay Social Security tax. So this is where you get into the little, there are little details that you kind of want to follow, and that's why you have tax advisors, right, to handle the details. I mean, the concepts are pretty simple. Pay your kids, pay less tax. I mean, your kids have a $14,000 zero tax bracket, right? Standard deduction. Well, why wouldn't you? I mean, if you could pay them $14,000, pay them $14,000, because guess what? They're not going to be taxed on that, and you're going to get a deduction for it, as long as they're doing something that's worth $14,000, right? You can't pay them worth something. You can't have them doing something that's worth $2,000 and pay them $14,000. That won't work. Okay. But for example, let me give you some simple examples. So I have a friends that they client, and they use their kids in their advertising and marketing for their business, and it legitimately, it's a family type business. They would have to go out and hire kids to model for them, so they hire their own kids. Well, they pay whatever the going modeling rates are for kids. Okay, that's what they pay. If they have them act in commercials, they pay them what you would pay a kid to act in a commercial. I had a client, a physician, and he paid his 8-year-old daughter to do his books. She learned QuickBooks, and she was doing his bookkeeping when she was 8 years old. She is now on Wall Street. So I actually believe that this is one of the reasons that the government makes this incentive. It's because, look, we would all recognize that, is it good for kids to learn how to work? I don't think anybody's going to dispute that it's good for kids to learn how to work. Is it good for kids to learn how to manage money? Nobody's going to dispute that. And is it good if kids are involved in the family business? I grew up in a family business. My dad was a printer with he was partners with his uncle. I have 5 siblings. We all worked in the printing business. And I got to tell you, it was an amazing experience. I started there when I was 12, and I worked all the way through college, working in the printing company. And it's actually where I learned accounting. I was in the bookkeeping department, and that's where I got my first accounting job. I was 14 years old, with my first accounting job for my dad's business. Well, did they get a tax benefit for paying me? Yeah, they did. It was a way for me to earn money. They got a tax benefit, but it was my money, so I got to use it the way I wanted to.
Now, is there too young? Like, meaning like I have a 2-year-old and a 4-year-old. Like, if I wanted to use them for advertising for the business, like modeling type promotion, like wearing T-shirts, is that too young?
I've absolutely seen that done. I think they're legitimate uses. Let's say, for example, let's say that you were a dentist and you did pediatric dentistry. Would you want to use your 2-year-old as an example when their first teeth are coming in? Yeah. Absolutely. Or your 8-year-old with the gap in between the teeth, right? Those 2 front teeth are missing. You'd absolutely use them for that kind of modeling. So if you think about it, you go, well, what could I use them for? I'll tell you another one. So teenagers, man, who knows more about marketing than teenagers? Nobody. Who knows more about social media than teenagers? Nobody. Who knows more about technology than teenagers? Nobody. So let them do those things. Why not? So my son, I will tell you, my kids are grown. They both work in my business. One works on the sales side, but also runs a video production company, and the other one works in customer service. And it's absolutely fantastic. Now, they're grown, but I'll tell you, I mean, I started employing them when they were young, for sure. As soon as I could have them filing papers or cleaning the office or whatever, I was absolutely paying them to do that.
Got it. But let's talk about energy. We talked about like how the government incentivizes what they want you to invest in. For a long time, I actually invested in a 401k, which we'll get into that for my own company. But then I started reading the book and I talked to, I think, an accountant that is trained by you. And what he said is that if you invest in like oil drilling, and I didn't even look at it as energy, that you can actually write off most of that investment and receive monthly cash flow. And when I thought about it, I'm like my 401k limits how much I can invest into it in a year. And then it doesn't provide me with any cash flow. So it doesn't help me today. Why am I settling for a $20,000 deduction when I can invest $200,000-$300,000 in oil in a year and get most of it deducted? So can you talk about like the benefits of investing in energy, and then specifically like oil drilling, what your thoughts are? Do you still think that's a good investment with everything going like solar?
Well, oil's still about $75 a barrel. So, of course, you always have to understand the investment. So, very important thing is never let the tax tail wag the investment dog, right? Never let the tax tail wag the investment dog. You always make sure it's a good investment first, and then let's look at how to make it most tax effective, right? So, here's the challenge with the 401k. The 401k is basically investing in derivatives. You're not investing in anything but a piece of paper. That's all you're investing in. It's really the class of assets is called the paper. It's paper assets, right? It's something that's printed on paper. Your stock certificate is printed on paper. You're not investing in the business itself. You're actually buying those shares from somebody else. You're not buying those shares. You're not putting money into the business. You're buying shares from out on the stock market. That's what you're doing with your 401k. You're probably buying a mutual fund, ETF, something like that, right? So why would investing in oil? So if you went and bought Exxon stock, you could do that in your 401k. Buy Exxon stock. You get the deduction for putting your money in your 401k. You pay taxes when you pull the money out of your 401k, and of course you have very few opportunities of how you can use that money in the 401k. Right? I mean, you're pretty restricted. It's a Wall Street play, basically. This is. The 401ks have been used to prop up Wall Street. That's it. Let's be clear. Wall Street is a Ponzi scheme. Okay, it is the most clear Ponzi scheme. Wall Street, Social Security, 2 biggest Ponzi schemes we've got in the world right now, and because they require new money, right, for the old money to make any money, you have to have continually inflow of money. Okay, but take oil. So oil is very different. Now you're investing in the actual drilling process. So you're actually producing oil. So it's not like you're buying a stock from somebody, which you're producing nothing when you buy a stock. But when you buy into an oil well, the driller is actually drilling for oil and actually producing the oil out of the ground. So, and you're at risk for that. right? I mean, something goes wrong, they better have enough insurance because you're going to be, you're a general partner. By the way, in order to do this and get the tax benefits, you're a general partner, meaning that you have unlimited risk except for whatever insurance they have. Now, good oil drillers will have, and good syndicators will have good insurance. But the reality is here's what you get. You get two big deductions going in. You get intangible drilling costs, which is everything except the equipment. And you get the equipment because it's bonus depreciation. So you actually get both. Now, typically they're 2 different years because your intangible drilling costs, you actually get to take that deduction. It's usually about 80% of the cost of drilling the well. You get to take that deduction the year before you drill the well. You get to take the bonus depreciation the year you drill the well. Okay, so typically you're getting first year getting 70 to 80% deduction, second year getting another 20 to 30%. Now it gets even better because when you start getting cash flow, the government says with oil, we're not just going to give you a tax benefit going in, we're going to give you a tax benefit coming out. So instead of being taxed on 100% of your income, like you would on dividends from Mobil Exxon, you get taxed on 85% of your cash flow. That's it. You get right off the top, you get a 15% off. You're only taxed on 85% of your income. It's called depletion. And you've written off your entire investment. So think about this. Let's say you put $100,000 into this oil investment and you're in a 40% tax bracket. Pretty easy to be. So that means the government's putting in 40%, you're putting in 60% because you're getting that $40,000 right back against your taxes. And guess what? You don't have to be a real estate professional. You don't have to be an active investor. All you have to do is you have to be an accredited investor. Okay. But that's it. You just have to put your money in and you get the deduction. And then when you pull the money out, you're only paying tax on 85% of it. So oil is, from a tax standpoint, has better deductions than real estate. The difference is that real estate, you get something that you don't get in the energy sector, and that is you get really high leverage. So real estate easily gets 70 to 80% loan to value, right? So you get out easily 4 times debt to equity ratio. So if it's a $100,000 project, you put in 20, the bank puts in 80. So that's where you get the big tax benefit from real estate because you're only putting in 20% of the money, but you're getting 100% of the tax benefit. Whereas in oil, you're probably putting in 100% of the money and getting 100% of the tax benefit. So you can't leverage as much. The other thing to remember in oil, and I've been involved in the oil industry for 40 years, so I actually have a little bit of experience in this. Actually, one of my first classes at the University of Texas was oil and gas oil and gas law, because I want to learn about oil. And the thing about oil is what makes it different from real estate is that oil is a depleting asset, right? It gets used up. So once it's gone, it's gone. So once the oil's gone, you have no investment left. There's no value after the investment's gone. Not like real estate where you have that residual value of the building, right? You're renting that. You're letting somebody use it, but you're not depleting it. And that's why real estate tends to go up in value, where oil will always come down, always, because you're actually depleting the asset. You're pulling it out of the ground and you're selling it. You're basically selling your assets.
Got it. That makes a lot of sense. Now, we talked a little bit about solar and doing it on investment properties, which that was another thing that one of the advisors that I think he's under your umbrella talked to us about. And he said about doing it on your investment properties. With solar, do you get a tax deduction or a tax credit? And for our viewers, like, what's the difference?
So you get both. So that's what I was saying. That's why I was saying, look, if you do it on your own property, you're going to get a 30% tax credit. Now, a credit is dollar for dollar. So it doesn't matter what tax bracket you're in. You get the same benefit whether you're in a 10% bracket or a 40% bracket. Okay? As long as you have that much tax to pay, right, you get that credit. And then what's left, actually with the new energy credits, some of them are actually refundable. So you can actually apply to get the money back instead of having to wait and roll it over from year to year to year. So that's the credit. That's the big thing. You get that whether you're a homeowner or whether you put it on investment property. What you don't get as a homeowner is a deduction. So we talked about bonus depreciation a number of times. And of course, we've got this bill in Congress right now where the bill in Congress would actually put bonus depreciation back to 100% beginning in 2023 and carry it all the way through 2025. So it's a huge benefit for particularly real estate, but also for solar. Because in solar, let's say, let me give you my example. So I put $100,000 of solar on my building, on my office building. Okay. So I got a $30,000 tax credit, but then I get to deduct as bonus depreciation 85%. So I have to give back 15%, half of the credit. So I don't get to deduct, I took a credit, so I don't get to deduct all of that. So instead of deducting $100,000 for bonus depreciation, I get $85,000. That's just the way the rule works. It's half the credit. So if it's 30% credit, you shave off 15% because that's half of 30, right? So now we're at 85%. So now you get an 85% deduction. But if I'm in a 40% tax bracket, at 85%, at 40% is about 35%. Okay, so I got 35% from a tax benefit because of the deduction. I got another 30% because of the credit. So now the government's paid 65% of my solar. I've only paid 35%. So to me, that's a pretty sweet deal. What it did was, so when I run my calculations on investments, I look at it as the government's putting in some of the money. Okay. And they're taking some of the benefit, right? It's just a partnership. And so for the solar, as an example, I ran the numbers with the solar company, and we figured that the return on $100,000 would be 7%. But because I only put in a third of it, my return was actually 21% because the government put in 2/3. Now I get a 21% return because I'm paying that much less in utility costs on my building, right? So I'm getting retail benefit because it's utility costs I would otherwise pay that now I'm not paying. All right. And so that 21%, I'm getting that return back. I have to pay tax on that because I'm not getting the deduction for the utility bill, right? So I am paying tax on it. So you have to pick that up too. Remember, you're paying tax when you get when it starts producing income, you're picking that income up into taxable income, just like on your real estate. You take your bonus depreciation the first year. Guess what happens second year? You start getting, you're getting real estate income, you're getting rental income, and you've used up your depreciation mostly because you took bonus depreciation. Okay. So some of that income is you're paying tax on. So you just have to know that you've got to build that into your calculations that the government giveth, but the government also getteth. And that's why they giveth, because they're expecting and I actually talk about this in my other book, Win-Win Wealth Strategy, where the government actually wins bigger than the taxpayer, except in one case. And it'll go to I think a point you want to bring up is your 401k. In the 401k, the government breaks even. That's it. Government does not make money on 401ks. But it's the only investment that they encourage that they don't make money on. They make money on business, energy, real estate, agriculture. They make money on all those. The government is better off. This is the thing that I just want people to understand. The government makes more money if you're successful and do the things the government wants done than if you put your money in a 401k. The government's better off. Well, the rich should pay more tax. Well, but if the rich pay more tax, the government actually has less money because they're not putting the money into the oil wells, into the solar energy, into the housing, into the commercial real estate, into the business. They're not. Okay. They're not putting, that's not where they're putting the money. The reason they're not paying tax is because that's where they're putting their money. Because remember, the first question I told you your advisor needs to ask is, how do you make your money? Second question. Now I'm starting to hear advisors ask that first question. I suspect it's because I read Tax Free Wealth. But they don't ask the second question, which is, what are you going to do with your money? Because what you're going to do with your money has a bigger impact on your tax situation than how you make your money. Because if you put your money, let's say you go put your money into savings, there's no tax deduction for putting your money into savings, right? None. Let's say you put it into your house. There's no tax deduction for putting your money into your house. I'm going to go buy gold and silver, or I'm going to go buy Bitcoin. There's no money. There's no tax benefits for that. But I'm going to go invest in oil well. Now there's a tax deduction. I'm going to go invest in a duplex. Now there's a tax deduction. I'm going to go invest in a business. Now there's a tax deduction. But the other side of that is, you put your money in the house, there's no revenue that's coming off the house. So the government's not getting any revenue from the money you put into your house. So they're not going to give you a deduction going in. They're not going to contribute to something they're not going to get any money from. You wouldn't go into a partnership with somebody in business. You wouldn't invest in something that's not going to pay you any dividends. That would be crazy. Why would you do that? The government doesn't do it either. Okay, they're happy to go into business with you. They're very happy to go into business with you as long as it's the type of business they want you to go into. Okay, so that's why I'm telling you, when I run the numbers, and I run them over and over again, 401k, the government breaks even. They make no money on a 401k. But if you put your money into oil, agriculture, real estate business, they're going to make money, because when that money comes in, you're going to pay tax on it unless you continue to invest. And if you continue to invest, you can literally do it over and over until you die. We call that buy, borrow, die strategy in my book. And you can do that over and over and over again, and then you can never pay tax. But you put all this money back into the economy. So the government says, we're good with that too. Put the money back in the economy, put it back into your business. You're not going to pay any tax.
Here's a mistake that I made, Tom, whenever I started buying real estate, is I would calculate my cash on cash return. I would calculate my return on investment, but I never calculated the tax incentives associated with the real estate. So I never calculated a couple things. I didn't calculate the potential appreciation over time. I didn't calculate the tax benefits, the depreciation, and I didn't calculate the principal pay down as well too either. Right. And that's when I was like, oh man, like real estate's actually a lot better of an investment than I thought. Yeah. I was strictly investing based on cash flow. So if somebody wants to calculate, like, for example, return on investment in solar, but with the tax incentives, or somebody wants to calculate the actual benefit of buying that piece of property with the tax incentives, what's the best way for them to do that?
It's actually really simple. It's really simple. You take whatever tax deduction or tax benefit you're going to get. Okay. Mm-hmm. So if it's a tax deduction, you've got to multiply it against your tax rate. Mm-hmm. If it's a tax credit, it's dollar for dollar. Mm-hmm. Okay. So in my solar example, ended up being $65,000. My solar example. Okay. I'm going to take that off my investment because the government put that in. I didn't. So that means my real investment was $35,000. So if I get $7,000 a year, I'm going to take 7,000, divide it by 35,000, and that's my return on investment. It's 20%. Okay, that's my return on investment. Now, I'm not done, because that 20% is subject to income tax at 40%. Okay, if that's my tax bracket, right? Mm-hmm. So at 40%, that means that 20%, I have to take 40% off, or basically 8%, and my real return on investment is 12%. Okay, 20 minus 8. So it's, or another way to look at it is 20% times 60%. That's my share, because the 40% is the government's share. So that means I'm getting 12% on that solar, right? But most people, what they do is they take the $100,000. They say, wait a minute, I'm getting 7% on that, but I'm losing the tax benefit. So I'm really getting 7% times 60%, right? So I'm getting really 4.2%. No, you're getting 12%. You calculated it wrong. So solar is 3 times better than you think it is, because you're thinking it's only 4%, when in fact it's 12%, because the government put in 2/3 of the money. So on your real estate, you can do the same thing. Okay, let's say I buy a single family home for $100,000. I put $20,000 down. and I borrow $80,000 from the bank. Okay. Let's say that I get $8,000 net rent a year out of it, and I pay $6,000 in, $4,800 in mortgage payment. I'm paying 6% on the $80,000, right? So I pay 6% mortgage payment, interest payment on my $80,000. So I'm paying $4,800. Only I'm not, because remember, I get a deduction for that interest expense, right? So I'm really only paying 60% of the $4,800. I'm not paying 100% of the $4,800. The government's paying 40% of that $4,800. So, so what that does is your return just gets bigger and bigger and bigger, right? So in the first place, let's say on that $100,000, I got a $30,000 bonus depreciation. Okay, I'm going to make it easier. Let's say I got $25,000 because I can do this math. All right, that means that I put that if I got a 25% of that $100,000, so I got $25,000 deduction, which in my 40% bracket is worth $10,000, right? All right, but I only put in 20. I got back 10 from the government, so I really only put in 10. Okay, now what's my rate of return? Well, on $20,000, I'm getting 8% on my $20,000, and then I'm getting 2% times 4 because the government the bank put in 4 times as much as I did. So I'm getting 8% on the bank's money. 8 minus 6 times 4, I'm getting 8% on their money. So I'm getting 16% on that $20,000, but I only put in $10,000 because the government gave me $10,000, right? Because of the bonus depreciation. So what I'm really doing is I'm getting 32%. So here I'll give you a really simple way to look at the math. When you think of compound interest, right? Rule of 72, all that kind of stuff. You can go Google that. Basically, 2 plus 2 equals 4. Basically, you can double your money every 7 years at a 10% interest rate, right? 7.2 years, you can double your money. So 2 plus 2 equals 4. When you add debt, 2 plus 2 now equals 8 because now you've used the bank's money. And now you just doubled the rate of return, right? We went from 8% to 16%. So now 2 plus 2 equals 8, not 2 plus 2 equals 4. But now I take the tax benefits and I get double that again. So now 2 plus 2 is 16. So if you look at what's the most important part of this calculation, what gives you the biggest benefit? Taxes.
Leverage? Taxes.
Taxes. Leverage gave you went from 4 to 8 with leverage, but you went from 8 to 16 with taxes.
Taxes, yeah.
So taxes are a much bigger part of the calculation than even your debt, even your leverage. Taxes are the ultimate leverage because you're getting the government to put money into your investment.
Well, it's even like right now, like there's people that are like, oh, like, look, I'm better off renting a property than owning a property in some cases. And the way I think about it as well too, is I look at like, okay, you're only looking at it from a very short-term point of view. You're not looking at it from the interest deduction that you're going to get, which is going to save you money on taxes. You're not looking at any potential appreciation in the property. You're not looking at any principal pay down. Once you actually do the math on everything, like let's say you even pay by $100,000 or $200,000 on a property, over a 20-year period, that principal pay down in a 20-year period is almost like going to pay off for the property. So it's almost like when you actually calculate the entire thing, it's a much better investment than what you may be thinking about.
Let me give you a real simple example. Let's say you're in, because now people right now are cringing at a 6% mortgage rate. I'm going, are you kidding me? I paid 16% on my first house. Okay, so you're cringing at 6%, but let's say you got that 6% rate. Okay, but you're getting a tax deduction for it. So let's say you're in a 33% bracket. Okay, so basically you're really only paying 4%, right? You're not paying 6%, you're paying 4%. The government's paying 2% because you're getting a tax benefit equal to 2%. So now you're only paying 4%, right? You pay nothing on the appreciation because you can sell your own residence and make $250,000 on it and pay no tax, or $500,000 if you're married and pay no tax. Okay. Mm-hmm. So you're not paying tax when you sell it. You're getting a tax deduction while you own it. Okay. The principal reduction, that's just money you're putting from your left pocket to your right pocket. That's all that you're doing.
It's there.
It's just a savings account.
Yeah. A forced savings account.
Right. It's just a forced savings account. That's all it is. So yeah, and here's the other way to look at it. When you pay the principal down, whatever your mortgage rate is, that's your return on investment. So if I pay $10,000 of principal during the year and I have a 6% interest rate, I'm making $600 on that $10,000 because that's $600 I don't have to pay next year. So I actually do have a return on the investment on the principal pay down equal to my interest rate. Equal to my mortgage rate. That's my return on investment. So if I have a 6% interest rate and I'm paying down principal, then I'm getting 6% on that principal. Because people ask me all the time, should I pay my mortgage down? I said, well, which is greater? The amount you would get if you invested it somewhere else, or the interest rate on your mortgage? Because that should be your calculation. Yeah. Because the interest rate on your mortgage is the rate of return you're getting on your principal pay down.
Basically. Yeah. It's funny because when interest rates were at 2-3%, I had a friend that was paying down his principal residence. And one of my things was like, one of my things was, and I did the opposite. Instead of paying them down, I just bought more. Right. And now we look back at the result is he's got one paid off property. I have 57 units in California, you know? So it's like, it was just completely different. What I did want to ask you this is, it's funny because I I used the cost segregation and 100% bonus depreciation in 2019 when I bought a 25 unit building. And I talked about it online. And then somebody said you're such a scumbag. You don't pay any taxes, blah, blah, blah. And then I thought about it. I'm like, in property taxes alone, I probably paid more than that person's income just in property taxes alone. But then I thought about it even more as well too. And I've heard that you can fight property taxes based on and what's that process look like? And what does that process look like to be able to do that?
So good news is there's a chapter on property taxes and tax-free wealth. So go to tax-free wealth, look it up. I talk about property and sales tax. But property tax, it's fighting property tax is more of an art. It's a negotiation, because what you're doing is you're comparing your property to all the properties around it. So you have to go, okay, are they overvaluing my property compared to everybody else? Or are they overvaluing my property because they're valuing it more than it really should be valued? And so that's what you're looking for. Those are the two primary things you're looking for is, and I'll give you an example where you can get, I got whipsawed on this. So I built a house in 1993 and it had a basement, and the basement was 1,000 square feet and the upstairs was basically 2,200 square feet. Okay. Mm-hmm. The way the property tax rules worked in Maricopa County is that was treated as if I had 3,200 square feet on one level, because the basement, because it wasn't at least half as big as the upstairs,
I remember
was not considered a second level. It was just added into one level. So a 3,200 square foot ranch house is a way higher price per foot than a 3,200 two-story house, right? Mm-hmm. It's way more.
Yeah.
It's way more. And so I actually got whipsawed on it. And, I made a mistake. I should have built the house with a 1,200 square foot basement, and it would have saved me on property taxes. So it's little things like that you have to look at. Because I was going, wait a minute, why is my house being appraised so much more than my next door neighbor? His house is bigger than mine, but mine's being appraised higher. Well, the reason was because he got credit for a 2-story house, and I was considered a 1-story house. And that's why. And it's something that simple. So that's why I like having, I think Robert Kiyosaki's right when he says investing is a team sport. right? I think having the right people on your team. What I did is I went to a buddy of mine who was a property tax expert. I said, what do we do here? He says, basically, you blew it when you built the house. You should have added 200 square feet more of basement, and you would have paid less tax with more house. And that's the way it would have been. I mean, it would have appraised more. I would have gotten the value out of it. But because I shorted myself, I only need 1,000 square foot basement. But if I'd had a 1,200 square foot basement, right? And so then now I have a 3,400 square foot home. But my basement is at least half. Anyway, you got to do the math. I'm not sure I've done the math right on that. But if in that case, because my basement wasn't half the size of my main story, so my main story is 2,200. Okay, so half of that would have been 1,100. I need to be at least 1,100 square feet in my basement to be counted as a second story, right? So you have to you've got to find true comparables and go, okay, what's a true comparable? What you don't want to be, let's say that your neighborhood is right next door to a gated community, a fancy gated community. You don't want to be pulling comps out of the fancy gated community, right? You want to pull comps out of your neighborhood. So it's a negotiation. It's just a negotiation and it's with the county assessor, and anybody can do it. But again, I highly recommend you get some help.
Experts.
Yep, get some help with it.
Is there any advice, and this will be like the last question before we conclude, is there any advice for people looking at, so I have a lot of clients that are older, they're tired of managing rental property, they don't want to pay taxes, and they're considering just waiting for the step up in basis when they die, but they'd really like to just free up some mind space. Is there a way that they can sell their property and reduce their tax bill and sell their investment property?
Yeah. So here's the number. So you're familiar with 1031 exchanges, like kind of exchanges, right?
Yeah.
So you can sell any kind of investment real estate and buy any kind of investment real estate, right? They don't have to be the same kind of investment real estate. So let's say that over the years, like you got 57 units. And you go, I don't want 57 units. I don't want to have to manage it. I don't want to have to deal with it. I don't even want residential anymore. I want commercial. So here's what you do. You sell your 57 units, go buy a Walgreens. Because it's a triple net lease. And you put all the money from your 57 units into the Walgreens, and they send you a check every month. And it's exactly the same as owning a corporate bond, without the tax consequences of selling your real estate and buying a corporate bond. But it's exactly the same financially. It's exactly the same as corporate bond. You still get the depreciation on the real estate. You get the 1031 exchange on the real estate. And if it goes up in value, you go borrow against it, pull your money out that way. Debt is not taxable. And then that's the buy, borrow, die.
What are your thoughts on Delaware statutory trust?
So Delaware statutory trusts are great. So basically the way they work is if you're syndicating an investment and you think that some of your investors will want to do a 1031 exchange and some will not, the Delaware statutory trust is really the easiest way to do it. Think of it this way. It's like a limited partnership because you get one document controlling the trust. You have a trust document basically. Right? But all the owners are individual owners. So they can each choose, do I want to do a 1031 exchange or not? You have to set it up from the beginning. You can't do this later on. You got to set it up from the beginning. I am seeing more and more real estate developers use Delaware statutory trust. I like them.
I love it. Okay. So if somebody wanted to buy your book, where can they do that? If somebody wanted to maybe reach out to one of your advisors, what's the best way to do that? And if somebody wanted to maybe follow you on social media or whatever, where could they do that as well too? And any last thoughts?
I'll give you all these. Okay. So buying the book, Amazon, Barnes & Noble, it's the most popular book in its category. So it's really easy to find. Okay. There you go. Tax Wealth. I will tell you, here's the third edition right here. Third edition of Tax Wealth. You have the second edition. This is the third edition. You have a signed copy from me. There you go. 2023. Here's the third edition. I see you got all sorts of markups in it. If you want to follow me, I have a really fun podcast called The Wealthability Show. And also I have my own YouTube channel, and I'm pretty much everywhere. I even do TikTok because the most difficult thing in the world is to teach tax in 30 seconds. So that's why I do TikTok. We actually had we had a couple go viral. So the reason we do TikTok is because I saw teenagers promoting tax-free wealth on TikTok. I'm going, I need to be on TikTok. So I got on TikTok. We're on Instagram, we're everywhere else. If you want to get a hold of one of our advisors, so we now have a franchise. We have a franchise, Wealthability franchise, and just go to wealthability.com. We'll actually do a free second opinion on your tax return. So if you're wondering, did I pay too much tax? Is there something I can do to improve my tax situation? Give us a call, no charge, wealthability.com. Just go to wealthability.com, click on the consultation button right on the front page. And we're really good at reaching out, getting back to you, getting some information, looking at your tax return, getting you a second opinion. If you're doing everything exactly right and there's nothing you can do, we will tell you. But that's maybe 1 out of 100 that's doing that. Most people are paying too much tax.
And what I would recommend to our viewers is this is most people's largest expense. Taxes is most people's largest expense.
For sure.
So if you can find a way to find the right advisors that will help you save some money on taxes, that extra money that you save every year, you can reinvest it and you can build wealth a lot faster. I want to say thank you, Tom, obviously, for taking the time to be on the show. To our viewers out there, I do want to say thank you as well, too. Today we had Tom Wheelwright. He's the author of Tax-Free Wealth. We talked a little bit about bonus depreciation. We talked about real estate incentives. We talked about energy. We talked about solar. There's other stuff that we could have talked about as well too, like business, 401ks. If you're interested in learning, read the book. Thanks again, Tom, to our viewers. Until next time, and thank you again.